So, how do money managers actually make money? What are the economics of the investment management business, and how do financial advisors get paid? These are questions that I commonly get asked, and I am just going to get straight to the point and answer them on this episode of Analyzing Finance with Nick. Most managers make money on a flat fee basis, which is usually a fee as a percentage of the client's assets under management. So say if you're running a $10 million investment advisory practice and you charge a flat 1% fee, then the advisor is going to be making about $100,000 of years in fees. And that is deducted either monthly, quarterly, or annually. And quarterly or monthly, it's prorated either 1/12 or 1/4 of the annual fee over that time. And there are some advisors that will also do declining fee balances for larger accounts. So say if you have one client with, say, only $1 million in the advisor's managed account, it'll be charged 1%. But if somebody puts, say, $10 million in it, they'll give them a discount and say charge them only 0.6%. And the reason you do that is because the amount of work at 1 million versus 10 million is more because there's more complications with more money, but it's not proportionately more. So, and also that fee goes up with the size of the account. 0.6 of 10 million is still a lot more money. In this case, it's 0.6 of 10 million would be 600,000. It's still a lot. Oh, it'd be 60,000. Sorry. Would still be a lot more money than 1% of $1 million, which is about $10,000. And on top of that, that fee is compounded. Every year, the advisor makes that 1% fee. And the incentive is lined up with the clients this way because as the value of the fee that the advisor earns goes up, and if the value of the balance goes down due to a bear market or the advisor not making good investment decisions, then that fee amount also goes down because it's proportionate to the number of assets in the account. For AI and simplistic type financial advisory decisions, you're seeing some firms switch to a flat hard dollar fee. So say like they'll charge $2,500 to either build a financial plan or to allocate the client's portfolio to a model that doesn't change. A lot of people in the industry are afraid that's going to spread to more personalized portfolios, but the scaling really doesn't work because it just simply wouldn't pay enough for an advisor to be worth participating to do that versus getting other job opportunities on the institutional side of the business, which is why I don't think it'll be adapted beyond smaller portfolios. And also larger accounts need more customized solutions that cannot be really just simply built by an AI or a model. The ones who try to do that could make some money in the short term by running a high volume business, but they risk alienating their clients in the long term due to lower service quality. The other type of payment structure is an incentive fee, or also known as a performance fee or a carry. This is generally restricted to accredited investors, and it really applies more to hedge funds and private equity managers and not more to traditional wealth managers because of a lot of the restrictions involved with it. And with this kind of structure, you get paid a larger fee, but only as a percentage of the profits. So if a hedge fund is charging 2 and 20, which is the classic payout structure for them, they have a 2% fee on the assets, which is in this case, let's use $10 million for the example, would be 200,000. And then you would also get a performance fee. So let's just say that 10 million goes up to 12 million and you charge a 20% performance fee. So you'd get paid 20% of the 2 million in profits, which is $400,000. So all in, the hedge fund manager in this case would take home about $600,000, 2% from the 10 million on the management fee, and then 20% of the carry. And so this aligns the incentives even more. There are even some advisory firms that will pay 0 and 20 or 0 and 30, and and they'll just go all in on the incentive fee. The management fee is really, for most hedge funds and private equity, just the charge just to keep the lights on, metaphorically. And they pay themselves the bonuses, and the big payouts are on the incentive fee. And a lot of adjustments can be made to this, such as advisors having a hurdle rate, which is a minimum rate of return before the performance fee kicks in. Because if you're a client, you go, hey, wait, why doesn't this guy just put it all in the S&P? The S&P averages about 8 to 10%, and he just collects a huge performance fee for doing nothing. So if it's, say, for an example is a large cap equity hedge fund manager, they may put a hurdle rate of whatever the S&P is and charge only a performance above the hurdle. Often, if there is a hurdle, the performance fee is probably often higher than if there was no hurdle. But that's kind of what can be put in to protect from that possibility. So overall, fees are pretty straightforward. They're either a flat fee, a percentage fee on the assets, a flat cash fee to set up a model portfolio, or a flat fee plus an incentive fee for more speculative investments such as hedge funds, private equity firms, or real estate collectives. Let me know if you have any questions. This is another episode of the Managed Money segment where we kind of deep dive into inside baseball in the industry. And if you like more of these, like, subscribe, share, and comment. Engagement is a good signal of what kind of content you want me to produce in the future. Thank you for watching.